Welcome to our conversation on financial reporting. The focus of this session is revenue, measurement, and reporting. There are several accounting standards which directly or indirectly affect the revenue measurement and reporting. For example, Ind AS 115 is a root, the main accounting standard which talks about the measurement and reporting of revenue. But there are also other accounting standards like Ind AS 2, Ind AS 10, Ind AS 21, and Ind AS 109. So these other accounting standards also influence the measurement and sometimes the reporting of the revenue and its effect on the bottom line of the company. So Ind AS 115, revenues for the contract with customers, establishes principles for reporting useful information about the nature, amount, timing, and uncertainty of revenue and the cash flows. It applies to all contract with the customers except those covered by other specific Ind AS like lease, insurance, and financial instruments. You may ask that how come then financial instruments we have mentioned here? Sometimes the revenue is received in the form of financial instrument. So the measurement of revenue depends on the measurement of financial instrument. That's why I said that sometimes the revenue is affected indirectly by other accounting standard, that is 109. Ind AS 115 gives five-step model to recognize revenue. It introduces five-step model to recognize revenue. First is an entity has to identify the contract with the customer. There has to be a contract with the customer. If there is no contract with the customer, then revenue recognition will not happen as per 115. Second, it says it has to identify the distinct performance obligations. There has to be a performance obligation on the part of the seller. The third is the transaction price is to be determined. There has to be a price, explicit or implicit, including the variable considerations and including some significant financing components. Fourth, the transaction price need to be allocated to the performance obligations. Some basis, for example, it can be on the basis of the standalone selling price. Finally, the revenue is recognized when or as the entity satisfies the performance obligation by transferring the control or services to the customer. As and when the transfer of control happens, or the transfer of goods or services happen, the revenue has to be recognized. So in every transaction involving revenue, one need to check these five steps. Revenue may be recognized at a point of time or may be recognized over a point of time. It depends on how is the control transferred. Sometimes the control is transferred gradually. If the control is transferred gradually, then the revenue is also recognized gradually over a period of time. Let us take some examples where there may be a non-cash consideration. If there is a non-cash consideration, how to measure the revenue? For example, A Limited supplies 150 computers to B Limited under a contract. In accordance with the contract, B Limited, the buyer, agreed to pay A Limited, the seller, by transferring the right to use one of the patents of B Limited. The patent will allow A to improve the quality of its computers. So B is not paying cash to A. B is transferring a patent. So it is a non-cash consideration. In such cases, Ind AS 115 gives certain methods of recognizing the value of, measuring the value of the revenue. The fair value of the patent is 500,000 or 0.5 million. The standalone price of each computer is 2,500. So what will be the value of revenue as per Ind AS 115 when there is a non-cash consideration? So Ind AS 115 says that wherever the transaction involves non-cash considerations, in this case, the presence of patent, the transaction price shall be measured at the fair value of the non-cash consideration, which in this case is a 500,000. Is the fair value of the patent, not the fair value of the computers, but the fair value of the patent. The transaction price, therefore, will be measured at the fair value of the non-cash consideration. The standalone computers may cost 375,000. Even though the standalone price is 375,000, Ind AS 115 requires the revenue to be measured at the fair value of the consideration received. And the fair value of the consideration received is the fair value of the patent. And the fair value of the patent is 500,000. So it is not the standalone value of the computer which is recognized as a revenue, but the fair value of the non-cash consideration received will be shown as the consideration for revenue. Let us take an example where the transfer or the price or the consideration includes some financing component. For example, A Limited sells 1,000 units of goods to a customer for a future payment of 45 lakh. Cash is not paid immediately. It is paid after 3 years. The company's discount rate for such a financing agreement is 9%. So what will be the value of the revenue? So will it be 45 lakh? So what will be the value of that? So under Ind AS 115, when the contract has significant financing component, the transaction price is the present value of the promised payment, present value of the money receivable. So in this case, money receivable for this 1,000 units is 45 lakh. But this money will be received after 3 years. So that is the time value of money. So one need to discount that. So to discount, we need a discount rate, and that is 9%. So in this case, the 45 lakh, which is receivable after 3 years, but it will be recognized today at the present value. And the present value is 34.74 lakh. The difference between 45 and 34, that is 10.26 lakhs, will be treated as interest to be shown in the, not as a revenue directly. So recognize interest over a period of 3 years and recognize 34.7 lakhs as the revenue. So let us observe this. So 34.75 lakh is the present value of 45, receivable after 3 years, discounted at 9%. So by using the PV table, we can find the present value. The difference between 45 and 34 is the interest component. And 45 minus 34 is interest. But how is this interest charged over a period of 3 years? Every year, the interest is calculated on the opening balance. The opening balance in the first year is 34.75. Interest 9% on 34. So closing value is 34 plus 3, 37.88. And on this 37.88, once again, interest is calculated for T2, then again T3. So 3.13, 3.41, and 3.72 is the interest to be recognized year after year, whereas 34 is recognized in the year 1 as the revenue, not 45. Sometimes the transaction may have a bundle service. Instead of one product, the seller sells a bundle of services. For example, mobile plus service, a product plus service. So let us take an example. sells a mobile phone along with a 3-year software update services. Customers are required to pay the full amount at the time of the purchase. The delivery of their mobile phone takes place immediately. The cash may be received immediately or later, but the cash is paid for two things. One is for the mobile and the services. So it's a case of a bundle product. The standalone selling price of mobile without service is 30,000. The standalone selling price of the software update services is 5,000. So total standalone will be 30 plus 5, 35. But the bundle sale, the transaction price charged to the customer is 30. So instead of 35, the customer will pay 30. But this 30 is partly for the mobile and partly for the software. So in such situation, Ind AS 115 says, identify the performance obligations. There are two obligations here, mobile phone and software. Then determine the transaction price. The transaction price is 30,000. Allocate the transaction price to these performance obligations, mobile phone and the software, on the basis of in the ratio of the standalone prices. So 30,000 into 30 by 35 and 5 by 35. So the allocated revenue for mobile phone is 25,714. The allocated revenue for the software update is 4286. So instead of showing entire 30 as a revenue for the mobile, it is allocated over the bundle services. So the revenue attributed to the mobile is recognized immediately, whereas the revenue attributed to the software is provided over a period of 3 years. So instead of showing entire 30,000 in year 1, 25,714 is shown as the income of the year 1, and the software portion update service will be distributed on an SLM basis over the period of the software updation. Now let us see the interaction between Ind AS 21 and Ind AS 115. Ind AS 21 affects the revenue by requiring foreign currency transactions to be recorded using the exchange rate on the date of the transaction. Ind AS 21 deals with the foreign currency transactions. If the revenue involves foreign currency, the revenue arising for the foreign customer is initially converted into the functional currency by using the spot rate. And if the transaction is on credit, then any subsequent exchange differences on receivable are not treated as a revenue, but recognized separately as a currency gains or currency losses. So foreign operations, the revenue is translated into reporting currency using the exchange rate at the rate of the transaction. For example, an Indian company sells goods to a US customer for 10,000 USD. Suppose the exchange rate is 75. The revenue is recognized at 10,000 into 75 by converting the foreign currency into the spot rate. The corresponding receivable is 10,000 USD. But at the end of the accounting year, suppose the exchange rate moves up from 75 to 76. In that case, the receivable is remeasured at 7,60,000, but not the revenue, but only the receivable. The 10,000 increase is recognized as the currency gains in the income statement. So the revenue is not affected with the future or further changes in the currency exchange rate. But the receivable, it will be affected because of the changes in the foreign currency. Ind AS 10 and Ind AS 115. Ind AS 10 is an interesting accounting standard which affects the revenue by requiring entities to assess events occurring after the reporting period but before the approval of the financial statements. Suppose a company recognizes revenue 500,000 for goods sold on 31st March 21, suppose. On April 21, before the approval of the financial statements, the company goes bankrupt, confirming the customer's poor financial condition and if the revenue is reduced to 4,20,000 based on the revised estimates, then that 80,000 reduction is adjusted in the financial statements ended 31st March. So this is the impact of Ind AS 10 on Ind AS 115, impact on the revenue measurement. So the revenue is, in this presentation we saw, the revenue's main accounting standard is 115. But is also affected by Ind AS 10, Ind AS 2, Ind AS 21, and the measurement of revenue also depends on the nature of the transactions. And measurement of revenue is an important part of financial reporting, with the gross profit and net profit and other measures of performance depends on the correct measurement of revenue. Thank you very much.